I'm glad to see that there are some familiar faces here and some new ones that I've not met before, but they are all HBTU guys. So I'm glad. Uh, let's do a learning session today. Let's hope
Yeah,
this will be
I was gonna
as
say,
interactive.
Mayank, Bobby, that I mean, it's good to see familiar faces, but I think today's session was more for. I mean, it's really a basic topic, right? So hopefully, people find it useful. But I suspect for a lot of people, it may just be a repeat of things that they kind of know. But we'll see. We'll see how it goes.
Yeah. Do you want it to be more interactive session or do you want to give people
We can.
opportunity?
Yeah, so maybe I can kind of flip through the slides really quickly, and of course, along the way, if you want it to be more interactive, then feel free to stop me and feel free to ask questions or have a discussion or whatever.
Okay, let's start.
All right. All right. Are you guys able to see my screen?
Yes, sir. Yep.
Okay. So, just in terms of a quick intro, there was a little bit of a discussion that happened, with a couple of people, including Bobby, and we were kind of reflecting on it's been several months since Bobby and team formed this group, and there were some observations, and there was a discussion around that, and just based on the observations, one of the things that we thought might be useful for a subsection of the audience is really to go back to fundamentals about what is a startup, why do people really do startups, what does a typical startup ecosystem look like, and cover a bunch of very very basic topics. uh, so I took a stab at about four or five topics, and this is intended to be a two-part kind of a presentation. I'm only going to cover a subset today. Part two is more about basic startup financing and how do VCs work. So, if there's interest towards the end of this presentation, then I can do a follow-up presentation some other day. So let's just dive right in. A quick intro. I have a bachelor's and a master's in computer science. I spent the early part of my career as an engineer and a development manager. Ultimately, got an MBA. Uh, since then, I've mostly spent my time in tech, more at the cusp of product and business. About equal amounts of experience doing consumer and B2B, and about equal amounts of experience between very small companies like startups and uh, hyper growth companies, mid stage companies, and then large mature companies. Uh, I've also done my own startups, one of which was acquired by Google. And then another interesting experience that I thought was a great learning experience for me was having worked at a hyper growth unicorn that went IPO. Okay, so let's just dive into the topics. This is the overall theme here is really like what is a startup and why do people really do it? And the reason I wanted to cover it was because several of you might have noticed if you look at our WhatsApp group for startups, you'll find like there are a bunch of people doing a variety of things. They're all interesting, they're all entrepreneurial, but the same definition of what is typically considered to be a startup does not apply to all of them. So, and that is useful for people to understand because uh, if people are looking at very, very different kinds of businesses that they've started as startups, then you cannot follow the same recipes for success or expect your business to evolve the same way. So I figured let's briefly talk about what is innovation and what is entrepreneurship. Uh, Romel, do you want to take a without reading the slide? Do you want to explain what the difference is?
Uh, okay, that's a good one. So I think innovation is more uh, I would say horizontal. It doesn't mean that you need to be an entrepreneur to innovate something. Wherever you are, you can innovate. The ideas or the concepts. Where the entrepreneurship is, take that innovation to the next step, start executing, and lead. Actually, it.
Exactly. Okay. So, so
Okay.
that's exactly it. Innovation is more about just, coming up with something new, but you could be sitting in a lab or you could be writing a paper or whatever. And, there are tons of patents that are filed every year. They're all innovations. And more than 90% of the patents that are filed never really see the light of day in terms of a product or a service that people get to use. Right. So entrepreneurship is more about how do you take a concept that may have been an innovation and turn it into something tangible and usable that people can use in their everyday lives. One minor distinction, there is incremental innovation and then there's breakthrough innovation. So incremental innovation is, somebody's already come up with a brand new idea, and year over year, you keep making it a little bit better. So some examples would be, you go from like 2G to 3G to 4G to 5G networks. Similarly, every year Apple comes up with a new iPhone, right? So the new iPhone is always better than the previous iPhone. So there's some innovation, but it's not a radically new innovation. So that's an example of incremental innovation. And your breakthrough innovation is something that comes once in a while. It radically shapes and shifts the markets as we know them. They're wildly disruptive, and oftentimes they will end up creating entirely new categories. Right. So an example would be the first time Steve Jobs came up with the iPhone. It just entirely ended up creating a new category, right? The smartphone or the modern smartphone as we know it. Same thing with WhatsApp. I mean, there were messaging apps and chat apps prior to that, but WhatsApp basically came up with the personal messaging category. And there are other examples, like iPad creating the tablets category and so on and so forth. So why do I mention this? I think I mention this because regardless of whether you're doing a startup and regardless of what people's definition of a startup or a new venture is, innovation and entrepreneurship exists in both cases. Um, Okay, just some examples of innovation. So like you can literally innovate across any dimension. So it could be a product innovation. The example there is iPhone. Uh, it could literally just be a business model innovation, and the best example there is Salesforce. Uh, Not like they really came up with new tech, not like they really came up with a new product or a new category. They basically said, we're just going to come up with a new business model. It's going to be called SaaS, and essentially instead of buying software, you can just rent it, right? Uber again, like their basic innovation was service, right? They didn't really come up with new technology. They didn't really come up with a new business model. They were just like, we're just going to innovate around service. AI would be a great example of a fundamental tech innovation. And Amazon, you could also innovate, just around processes. And Amazon is a great example. It's probably one of the most efficient, operationally efficient companies out there. And while they do a lot of things, I would say the secret to their success is really the innovation that they do around their internal processes. And usually, what you'll find is if you innovate across any one of these dimensions, that's good enough to have a good chance at being a successful startup. But while these successful startups will not stop at just one innovation, it'll usually comprise a combination of a couple of dimensions. Okay. So this is the big one that I feel is really important as it pertains to our incubator or accelerator group, which is what is a startup versus a small business. Uh, Look, like there seems to be a lot of excitement in India about startups, and I'm very excited that India is so excited about startups. I've talked to so many people, HBTU students, alums who are all trying to do startups. Very, very exciting. I see lots of passion. I see people talking about how Modi is supporting startups. It's in the news all the time. Uh, but there seems to be like people approaching at startups from very different directions. And I think where we need to all level set is the excitement around startups essentially comes from one singular definition of what a startup is, and that is a tech based startup. If somebody goes and opens up a yoga studio or a fitness studio or a gym, great, right? It could be a great business. You could make decent amount of money and all of that, but that is not really a startup. So I would refer to that as a small biz. And I think at least for the group that's participating in the incubator, uh, I think if we could align around that definition of a startup, that look, fundamentally, it's got to have tech as a core competitive differentiator or something that really is at the essence of what would ultimately make the startup successful. I think that's a key ingredient. Because, and the reason, as I alluded to in the beginning of this presentation, was uh, if you think about it any other way, then anything else that you read out or try to learn may not necessarily apply to your startup. So if you have a yoga studio and you start thinking about how VCs fund or how they do rounds, it'll just send you down the wrong rabbit hole. Similarly, customer acquisition, marketing, literally everything is radically different between how you build a tech startup versus how you would build a, I don't know, a yoga studio, for example. Uh, now, also, I mean, you can read the slide. I've listed some differences, but the two big ones are uh, the the fundamental approach between a startup that is tech based is, hey, we're going to look for explosive growth. We're going to operate very, very quickly, and we are shooting to disrupt an existing market or literally create a new market. So very, very high risk. And usually the way the financing works is you give up a part of your company in return for money. And the money is given to you by a particular kind of investor, which is called the VC. Right now, if you're opening a yoga studio or an, I don't know, an Ayurvedic clinic or anything that's not tech based, then essentially you're trying to play in a market that is already very well defined. There may be shifts in consumer behavior. Maybe there's a trend that's demand is growing. So you're like, okay, this area or this market could make room for one or two more players. So let me just open another gym. But largely, you're not changing the definition or trying to disrupt a market that already exists, right? That's one. The second is, so fundamentally, if you're not trying to disrupt a market, you're essentially taking a smaller risk. And then the kind of financing that is done is radically different. Usually you will do debt financing. So you will not go to, I don't know, for example, you'll usually raise money from something like a bank. You'll take a loan, and you'll essentially pay an interest on that loan and repay it in a finite period of time. You do not typically give up ownership of your company. Right. So let me pause there and see if there are any questions, or does that make sense? Okay.
So I have one question, sir.
Mm-hmm.
So when somebody says, some, the area of business, like, it is disorganized, and somebody try to, organize it and try to play around with it, try to set up the business. So in which category it will fall? It in the process one, the Amazon example that you gave in previous example, or
Uh, so, like, what kind of innovation would that be?
not what kind of business will be, but what kind of startup will be, because you were giving different examples, just like in case of
Yeah.
Amazon, right? Amazon set up some, they did some process that like product innovation, iPhone,
So,
and the
right, right. No, that's a a good question. And typically, when a startup is being formed, they're not being formed to organize a disorganized industry. Uh, like I can't think of any startup that on day one when they decided to build the startup, they were like, we are going to innovate around organizing a very, very I don't know, disorganized industry, right? uh, Now what does happen is, as startups evolve, right, that's as they kind of pick traction along the way, at some point, for them to really conquer the market and to really kind of take over the market, they often have to grapple with the disorganized market as a challenge. And then, by raising enough money, they're kind of like, okay, we're going to go. And for us to continue to grow and really become huge, we do need to aggregate the market. So that is usually more of a hurdle that people run into along the way than a problem that people identify at the outset and try to build a startup around.
Okay, thank you.
Did that answer your question, or do you have an example of somebody who's doing a startup where right at the outset they're trying to organize?
No, I mean, yeah, I pretty much I understand it, but I just want to give that kind of business. What it will be, a startup, or what kind of business it will be, or disorganized sector, and
I
people.
think I think that just falls under go-to-market and growth once you reach the growth stage.
Mhm.
And it's a great question, because I have come across multiple people in India trying to do a startup where fundamentally on day one their idea is, hey, all these things are disorganized, I'm going to go organize them, right? So nothing wrong is a problem statement. It is a valid problem. It's a huge problem, and somebody who can solve it will benefit from all the rewards. The problem is on day one as a startup, nobody knows you, right? Nobody knows you, and you don't have money. And frankly, organizing a disorganized market is not, I mean, it doesn't require you to develop new technology or to develop a new, I don't know, model or whatever. It's literally money. Like, if you have the money and the scale, you can send out armies of people and you can start organizing people in different geographies, different markets, different segments, so on and so forth, right? So good question, good problem, but I think any startup that tries to do it on day one, they're chasing the wrong problem.
Okay, thank you.
All right. Okay. So another question that I thought was interesting, because as I found this, and maybe some of you may have found this as well or not, which is, we all seem to have slightly different motivations for why we are trying to do startups. And within our HPTI community, there's certainly a very wide ranging set of motivations. So typically, why do founders found startups? Really, it's one of two reasons. And if it's not one of those two reasons, then you really have to question yourself and say, am I am I really doing this for the right reasons? So the first reason is you just want to make tons of money. It is a very, very high risk, right? Most startups will fail and you will not make any money at all. Then a very, very small percentage of startups will make some money, and like a very, very minuscule percentage of startups will make tons of money, right? But that is the motivation, that, hey, let me just go and become an Elon Musk and make tons of money. The second reason is, you have a little bit of an ego, in a good kind of a way. You're looking to challenge yourself. You're looking to prove a point. It's kind of the same motivation that uh, like people who climb Mount Everest might have. Like, literally, they know, like, the chances of success are low. They know it's high risk, and they still do it because they get an adrenaline rush, and they're looking to just prove a point. Now, other reasons that often people will talk about is, hey, I'm passionate about this, uh, and they'll say, I don't really like working for anybody else, so a startup, I just want to work for myself. So I think all of those can be additional reasons, but they can't be the core reason, right? So your core reason has to be one of the first two, and then the others can be kind of additional reasons. So let me pause there, and I'm not going to take names, but I've come across multiple people in our group where uh, people have reasons other than this to other than the first two to do a startup. And my advice would be, don't cheat yourselves. If there's any other reason, please don't waste your time.
So one question, sir, I have, like, if
Mhm.
somebody want to do a startup, yeah, there may be that one of the reason, but there will be one more reason, like making the money fine. But at time, there is some real problem, okay, and people want to solve it. The problem is, there is a consequences on the society or the on the environment, okay, and that they want to solve that problem, and not only to solve the problem, okay, for to self satisfaction, making the society and environment better, along with the make the money. So in your point, where it will fit exactly, you will fit into the
So,
certain
so,
point,
so,
or
so those things only exist in people's theories. They don't exist in real life. Okay. So I'll give you an example. So I would ask you, I would flip it back to you, and I would say, can you name me one company on the planet where, look, there's an entire field called social entrepreneurship, right? So these are like, companies that kind of go try to solve social issues, right? Like you said, maybe related to the climate, but they are not. So that's why I try to level set us on a common definition of a startup earlier in the presentation. So all of those, look, if somebody wants to go and solve, pollution in Delhi, or I don't know, global warming or something, great, right? By all means do it. It's a big problem, impacts a lot of lives and all of that, and if it gives you self satisfaction, great. But you I would argue that you could solve it, but you can't also make money on the side as a startup. And I would actually challenge you to name one company that has made money solving a social problem. See, typically those are things that are done by NGOs and governments, right?
yeah.
And as companies grow, they do tend to, contribute something back to society. So they have like social responsibility groups and such. So yeah, they'll contribute to a climate fund, they'll contribute to homelessness and a bunch of other things. But that is not the reason. That is not their core, right? That's not the reason the startup was formed. And there are startups that are formed simply with social causes in mind, but they don't ever make money, because if they did, then collectively between the 10, 15 people in this room, one of us would have heard the name. And my challenge is, I don't think anybody on this call can name one company like that.
I agree.
Okay.
Agree with your point, because the ultimate driving force would be the money. Because without force, you cannot move the things. At least some
No,
should be a driving force, and that cannot be the alone driving force.
yeah, and don't get me wrong, right? So the thing is, like, that's a very good cause, and if you want to do it, like, you will, there's a sense of accomplishment. It's a tough problem. It's a problem that has a huge impact on people, and it's great, right? But it's not the whole startup buzz that India is going through, and it's not what made startups, right? I mean, that's not why Facebook and Apple and Amazon and Google and OpenAI and all these guys exist.
Oh,
Okay, let's move on.
Oh, just
Yeah,
wanted to say something. That OpenAI did not start out with that charter. It was a social entrepreneurship.
correct. And then they couldn't sustain it, right? So,
Yes. I
right.
mean, sustain it or the founders change their minds, whatever.
Yeah, I would argue the writing was on the wall day one, because, if, look, I mean, the minute Sam came in, that that's not Sam's background, right? Sam is not doing it because he's like, okay, let me solve a social problem. He's in because he wants to make money. So,
Yeah.
I get your point. So I think on day one, they might have had this intention to kind of just be a whatever, socially responsible AI for general good kind of a thing. But if you want to call it a pivot, I guess they pivoted very, very quickly from. I think until the time they actually hit that inflection point where, like, I think it was 2021 when like ChatGPT reached 1 million users like in 2 days or something like that, right? I
Mhm.
think immediately afterwards it was like you could tell, like, now these guys have decided they're going to make money.
Yeah.
Okay. Any other comments or questions?
I have one doubt or
Yeah.
point to discuss.
Yeah.
Like if we talk about physics wala or Unacademy,
Hmm.
so their intention was to solve a problem that high price like courses, na expensive courses they are selling at, like they disrupted the market.
Hmm.
Like the courses worth 1 lakh, they started selling at 5,000, and
Hmm.
initially so they started teaching on YouTube
Hmm.
free of cost.
Hmm.
So, like this example, I think is the one where the mindset was social, and now also like they are not they are solving a social problem like affordable education, I guess.
Well, okay. So So I'm not familiar with these two companies, Physics Wala and what is the other one? Unacademy,
Yes, yes.
right? I've heard the names, but I'm not familiar with what they do. Uh, so but okay, so if they raised money.
No, so Physics Wala has become unicorn, and an academy, I
Okay,
think, yeah, it's doing very good.
so then they've raised money, right?
Yeah,
So
yeah,
so if they've
definitely.
raised money and they have like a north of $1 billion valuation, then the people who have put in the money, they expect some returns out of it, right? So
Yes, yes.
so that means Physics Wala is monetizing or expects to monetize at some point. So if they expect to monetize, then why is it not a regular startup, and why do you think it's a social whatever?
So it might be that like they are raising the fund to scale, like they want to access the market.
No, sure, I get it, right? So let's say from their perspective, they want to scale and they want to do social good at a large scale.
Yeah,
But the
yeah.
point is they've raised money, right? Somebody's given them the money. And
Okay.
if you're saying they're a unicorn, which means it's north of $1 billion valuation, that means it's not a bank that's given them the money, it's a VC that's given them the money, right?
Yes.
So VCs expect returns. Returns will come only when somebody can make money out of that enterprise,
Yeah, profits
right?
should be there.
Yeah. So for profits, either somebody has to buy Physics Wala out. So like Google might go and buy Physics Wala out for like 10 billion and the VCs get 10x their return, right? Or Physics Wala has presented some kind of a business plan to the VC saying, hey, we are not generating money right now, but you know what? We are going to get 1 billion people in India to use us, and we'll figure out how to make money later. So there is a business plan that is not simply for social reasons. There's actually a monetization plan behind it. Now
Yes.
on day one, there are a lot of startups so Facebook on day one had no monetization plan. So Facebook was started as a hobby because Zuckerberg was interested in figuring out who the cute girls, the first year girls in Harvard, like he would run into them on campus and he'd be like, oh, that's a cute girl, like, but I don't know who she is or which classes she's taking, right? So day one it was just like a fun project. Along the way, as it grew, got traction, they were like, oh, we can actually make money out of it, so let's do it, right? So look, I can take a look at Physics Wala and come back, but my bet would be, if you're saying they're a unicorn, that means there's some monetization plan. Okay, should we move on?
Sir, what about Khan Academy?
So Khan Academy is a good one, and Khan Academy existed as like they don't. Okay, so the founder Salman Khan, he did kind of just wanted to do it for social good, and for the longest time he did it. Ultimately, they also started to monetize, right? Not 100%; it's still largely free, but they do monetize ultimately. So I would say that. Uh, so here's the other thing, right? So I think there's a distinction between whether a startup is making money versus whether a startup is uh, holds some value. So as an example, even if Khan Academy doesn't directly monetize, the people who are partners of Khan Academy, if they have access to that user base, then and they can reach that user base, then they probably have other ways of making money of those people. So I would guess that the people who invested money, they're probably making money off Khan Academy, outside of Khan Academy,
But
and it
conditions
and it could be that
which
Khan
would
Academy is an exception.
make
And
Khan
Mhm.
Academy non-trustable.
Sorry, your I can you repeat your question, please? Can you repeat what you said?
Now he's on mute.
He's on mute, sir. Yeah.
Okay, all right. So we'll move on then. Okay, so startup ecosystem. Who are the key players? I think so. All of this should be fairly intuitive, but maybe you can touch upon a couple of these. So one is this last bullet point, entrepreneurs. Uh, has Is this a new term for anybody on the call?
For me, sir.
Okay, so so I think I think you know people in our group who are aspiring entrepreneurs should really sit back and think if they are entrepreneurs or entrepreneurs. And literally, the difference, there's a very simple singular difference between the two. An entrepreneur is somebody who will take action very, very quickly. A entrepreneur is somebody who will keep sitting on the fence, keep attending lectures, keep attending seminars, keep attending meetups, always thinking about stuff, but will never take the first step of actually implementing something. And I think in our group, uh, I think it's interesting and important because a lot of the entrepreneurs are currently students. Uh, so they're kind of trying to do something, but not really. So the level of commitment there to really take concrete steps is a little bit mixed. And I think if you don't do that, then I think it's better to tell yourself that, look, I'm a entrepreneur. I want to be an entrepreneur, but I'm really not. And then maybe 5 years, 10 years down the line, you will actually be, in a position where you're able to take that risk, able to take those concrete steps. Better do that than to waste your time right now, because the opportunity cost is high. You could be much better off just focusing on your BTech and your classes and finding a job. Uh, but again, like, I think this is something for people to introspect and decide for themselves. Okay. So I think early part. So what does the startup ecosystem look like? Very similar to a large company with some differences. So I think when you're an early stage startup, the bulk of your ecosystem is essentially other co-founders, not your own co-founders, but co-founders or founders who are building other startups, your own co-founders, and your whatever team you might have, right? 2 or 3 people or whatever. And you once you built an MVP or a proof of concept, at that point, you can actually start to go out and look for potential partners, potential advisors, uh, and start to kind of think about what competition there is out there. I think one topic that I keep running into as I talk to startups in our incubator is uh, people keep talking about mentors. And I think there's a very key difference between an advisor and a mentor. Typically, startups have advisors, not mentors. Uh, so, an advisorship to a startup is typically a formal arrangement where uh, you may or may not pay any cash to the advisor. Usually, no cash is paid unless you're a very, very large startup. But you sign on an advisor in return for some equity, like a small amount of equity. A mentor is typically somebody who acts in a personal capacity it's more of a person to person contact. So a startup founder might say, hey, like, I want a mentor who I can go and kind of discuss how I'm feeling, what are the challenges I'm facing, how should I strike a balance between my work life and my personal life, and so on and so forth, right? So it's more of a person to person contact, whereas an advisor is more like an advisor to the company who may have individual conversations with the co-founders or anybody, frankly, at the company. But literally, it's an arrangement or an agreement between the company and the advisor. Any questions there?
Sir, are advisors known for their technical knowledge? Do we
So
need advisors for the technical knowledge in our company, for example?
you can get an advisor for whatever reason, right? So it could be hey, so usually, look, if you're building a startup that's a tech-based startup, then usually if that tech is hard enough and you need it for your startup, then you need to own that tech, right? So ideally, you would go hire somebody who's smart enough who can build it internally. Now, having said
Advisors.
that, you may need some advice occasionally because for example, you may run into a situation where you want to understand the guy who invented the ATM machine, how did he invent the ATM machine, right? So you may occasionally want a tech advisor, but usually you want advisors who are not necessarily really good at building tech, but have navigated the technology environment and understand how technology and technology based products work. So, and there could be a variety of reasons, right? So as an example, there was a time when I was uh, I opened a subsidiary in the ed tech space. So I was in gaming. I wanted to also operate in education, and I needed access to the market. I needed contacts. I needed somebody who knew how that market worked and could make connections. So I got an advisor who was a great name in the edtech space. Then I ultimately pivoted to doing advertising, and I knew nothing about advertising. And while I could very quickly learn what advertising was about, to get credibility for my company, I hired two advisors who were bigwigs in the advertising space. So I think there can be a variety of reasons why you get advisors. Did that answer your question?
Yes, sir.
Okay.
Sir, we have mentors like Larry Page in our tech industry, for example. He had mentored Elon Musk and uh, maybe Steve Jobs. Was he not an advisor at a point of time
Who
for them?
was Larry Page an advisor?
Larry Page.
I don't know. He might have, but it's not true that Larry Page mentored Steve Jobs or even Elon Musk. I mean, it may have been the other way around.
Elon
Maybe
Musk. Elon Musk has mentored himself
right.
from Larry Page, and he considers him as his mentor and guide. If you even search,
I think that may be marketing, but anyway, okay. Let's assume that's
he has
true.
speeches. Also has mentioned Larry Page as his mentor. Elon
Right,
Musk has mentioned.
right. So so mentorship is more of a one-to-one relationship, right? So anybody can be anybody's mentor,
Oh,
right? So
friend or something.
advisorship is more of a formal agreement between a person and a
Okay,
company.
company. Okay.
Okay, let's move on. Any questions or thoughts on this one? I know there are some fairly experienced people on the call, so if somebody has an insight or something they want to share, please, you're welcome. Okay. Okay. So the next one is, what does the journey of a startup typically look like? And I'm sorry, this is not a very clean slide, and the paths could vary slightly, but by and large, every startup goes through these stages, right? So literally, the first stage is you have an idea, and what you're hoping to get at the end of the stage is really a concrete problem that you figured out is worth you spending the next few years of your life trying to solve. Okay, and what does this comprise of? It's literally the founder or the couple of co-founders trying to figure out what should they do. Typically, they'll come up with like 3 4 ideas. They'll quickly prototype it. They'll go have conversations with other people outside and quote unquote sniff test it, right? So what does that mean? So what that means is when you go talk to people, is there excitement? Do the people who hear about it show excitement? And the people you're talking to aren't your friends and your family, right? These are people who are somebody in the industry who build products. Maybe they're like in leadership positions at large companies, so they understand the potential value of what you're trying to build. So you kind of very even before you build the product, you're very quickly trying to say like, is this a good enough idea at all? If I did this, what kind of market size can I expect? If I Even if the market is large, how would I try to get it into the market? Like, would I is it an app that I can just distribute on App Store, or would I have to build like a traditional sales channel and go hire a sales team? So like, just all of those things is literally a gut check on, hey, is this a good enough idea, right? So that is stage one. And the outcome there is, yep, this is something that let me at least spend the next few months on and, invest some money, maybe hire a couple of engineers and build a working prototype. Okay. So that is literally stage two. So stage two, what you're doing is you are putting in sweat equity. So it's at least the co-founders. You're not getting paid. Uh, so at a minimum, you are spending time and effort to build a working proof of concept. You may even hire an engineer or two, but usually it's, maybe an engineer, maybe the co-founder. Uh, and the outcome of the stage is a working proof of concept. It may be clunky. It doesn't have the best UI. It doesn't have the best performance. No spit and polish, but it's something that you can actually put in front of, I don't know, potential investors, potential partners, maybe even potential employees that you're trying to hire, and say, look, this is what I'm trying to build, and like this, here's a working prototype. This is the problem it solves. And what that does for people is, instead of hearing your idea just on a slide, once they get it in their hands or they see it in front of their eyes, there's a whole different reaction that you start to get, right? And once you've done that, it also gives you a little bit more credibility, because you've said, look, I just spent a few months of my life building this prototype, so you've shown a level of commitment, right? And you can use that to raise a small round, usually in the form of what is called a convertible note. Uh, is that is Does anybody not know what a convertible note is?
So I don't know
Okay,
what convertible note is.
so convertible note is like a loan. So typically at this stage, you would go to maybe friends and family, maybe some high net worth individuals, and you say, okay, you know what, I'm trying to raise $500,000, and 2 years down the line, I'll return this money to you with a certain interest. But the expectation is that before those 2 years is out, you will actually proceed to the next stage and you'll be able to raise money from a VC. And when the VC comes in and puts in money, then whatever the valuation is fixed for your startup. So let's say the VC comes in and says, I'm going to give you $500,000. So the valuation is 1 million, which means I own 50% of the company, right? So the 500,000 that these people have given you as a convertible note, you can convert that into equity and give them a discount on it. So it's like a loan, except that instead of returning money back to the people, you give them equity in the company at a discounted rate.
Uh, can we
Yeah.
not get a shifting mortgage from them,
Sorry, what?
like Elon Musk did? Shifting mortgage. Is shifting mortgage not possible? Because for in shifting mortgage, we can first put our assets of the company as mortgage. Then we can purchase a certain company or certain products. Then we can put mortgage on the certain product or company which we
Yeah,
have
but
purchased.
but but
Shifting
but but,
mortgage.
but on day one, what mortgage? What will you mortgage? You've got nothing, right? I mean,
Shares of the company.
at this early stage of your startup, like you have nothing to mortgage, right? So look, so if you're going to go, you can, if you own a house, you can go put your house as collateral, and you can go to a bank and raise money against that, right? But now, like, I mean, that is not how startups work, right? So if you want to raise money from a bank, then you're not really doing a startup, right? Does that make sense?
Yes, sir.
And if you go to a VC and say that, look, you give me money, I'll give you my house, on collateral, that's not how VCs work. So they're not going to
Mm,
do it,
okay.
right?
Oh, they want some return on the investment also
Yeah, and
because
they want massive returns on the investment.
they have put their efforts in by earning some money and putting on your business. This is also a
Correct,
point.
correct. They're saying like, I'm going to give you $1,000, and I'm hoping that 5 years, 10 years down the line, I'm going to get $10 million back, right? So
At
that's
least
not.
they want at least they want 12 more than at least 12% market rate per annum. I think so.
That is
Because
not
they are
VCs.
getting
VCs want a lot more.
okay. At how much more than 20%?
So they don't think in terms of percentages. They just think in terms of portfolio. And this is
Portfolio.
where, part two of this presentation, which I could do another
Sir,
time if
one
there's
minute. Sir,
demand.
I think there's one problem. A company cannot earn more than 20% casually. After selling more and more products, it is not casually more of easy task. It's a hustle task. So how is it possible that a company can generate 2x net profit
Well, nobody's talking about profit. I'm talking about,
revenue?
I'm talking about the valuation. So I'm saying the value of the company. So if you buy a house today for 1 crore, right? Next year, could it be worth 2 crores? It could, right? अगर 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 प्रॉपर्टी हॉट है इंडिया में, तो अगर आज एक 1 करोड़ में घर खरीदा है, तो मे बी अगले साल नहीं, उसके अगले साल 2 करोड़ हो सकता है, राइट? इन थियोरी, या हाउस इज नॉट जनरेटिंग एनी रेवेन्यू.
Okay, okay, they want valuation of the company to reach its peak.
Correct. They're looking for valuation. They're not trying to see, well. So your revenue growth, your profit margins, all of those are components that go into figuring out your valuation, but they're not. But you can have valuation without any revenue, right? And an example would be WhatsApp. Example would be Instagram. WhatsApp was bought for $22 billion by Meta. WhatsApp had zero revenue, right? Same thing with Instagram. Instagram was bought for $1 billion by Meta. Their revenue was zero, right? So this is not about revenue or margins. This is really about what is the value of that company, and value can come from reasons other than revenue or profit.
Goodwill. Is
It's
it
not
goodwill
goodwill.
or something?
It's not goodwill. It's potential to make money down the line, right? So if WhatsApp had 1 billion people using it, even though you're not making money right now, Meta is like, oh, if I have access to 1 billion people, I'll figure out how to make money of them later on. But for now, let me just go buy them. Okay. So we can, unless other people are interested in this, we can discuss more one to one in depth if you want.
So, sir, I have one question on that. As
Yeah.
you are saying, like,
Yeah.
the WhatsApp example where their revenue is zero, but still they will be acquired by 22 billion, 1 billion by
Yeah.
Meta. So, and you are saying, like, one of the point, like, it has the potential, the Meta realized that it has the potential to raise the money. Okay. So, and these are the one point. Okay. So what are the other point, when somebody need to perceive any startup, that, these are the point, that's really is not the point, I will say, benchmark or something else, that based upon that they can evaluate the company, like, that is how the Meta would have done, how many users are there, and any other point. That's what I will.
Yeah. So I think depending on the kind of business you're in, the kind of startup, there are well understood business models that VCs use, or potential acquirers use, to figure out the value of a company, right? Then there are other things such as, how in demand are you? Are you competing with somebody to buy that company, or are you the only ones trying to buy it out, right? There are other things like, is this a fear sale or a greed sale, right? So does somebody want to buy you out because they're worried if they don't buy you out, you're going to disrupt them? So they want to buy you out of fear, or are they trying to buy you out because you've cracked something that they feel if they acquired you, then it could 5x their revenue. So like OpenAI, lots of people actually want to buy them out because they're greedy, right? So they're like, yep, this is the wave of the future. This could do wonders for our business. Our revenue could triple, become 5x, 10x. So if somebody tried to buy OpenAI out right now, it would probably be a greed sale, right? Then there are other things like, maybe this one, right? So let's switch over to this slide for a minute. So typically, when startups are exiting, it's either because somebody is acquiring you, or you've kind of gotten to a stage where you're able to go public by filing an IPO, or, as is the majority of the cases, you just fail, right? You try it out and then it doesn't work out. Now, when somebody
Sir,
is acquiring you,
sir,
sorry, go
one
ahead.
minute. I have a question. Sir, Uber is also a start. Uber's also considered a startup, but it was launched on 2008
Mhm.
or more than that. 2003 maybe. Why is it considered startup till now also?
Yeah. Okay.
even
So
though it has not provided certain things which are required for a startup to provide innovation and other things.
yeah. So I think that term is used interchangeably. I think the point is, well, by the way, I mean, Uber is. I don't think Uber's a privately held company anymore. They went. Yeah, Uber went public a while back. So, but I understand your question in general. There are companies that are privately held, so they haven't gone public yet. Uh, but they're very large, right? And they already have an established business. So you're right. Some of these companies, even though they're privately held, actually are no longer startups. A startup stops being a startup the minute you figured out product market fit. As soon as you've cracked product market fit, you are really not a startup. Okay.
Okay, this
So
means
if,
we are permanent players, yes or no?
sorry,
This is a stage in which this is the stage in which we are permanent players or established players. You mean you want to say this? Maybe.
I don't understand your point. What do you mean? This is the
We
stage
are
when
in
the,
a stage. We are in a stage in which we are established players.
who's
In
we?
for example, the founders. I am taking example of the founder. For example, in stage one, a founder in which a person, for example, in stage one, a startup, a business is in a startup format in which it is establishing itself. In stage two, it is established
Yeah.
when
So
it exists.
correct. So stage three mein is really where you're really trying to look for product market fit, right? The minute you find product market fit, technically you're not a startup because the sole goal for a startup is to find and achieve product market fit. So what does product market fit really mean? Okay, so what happens once you achieve product market fit? All you're doing is you're scaling, right? So actually, yeah. So let's come to this slide. So does anybody want to explain what product market fit is? Why does a startup stop being a startup the minute it hits product market fit?
Because maybe it is using the it is it is producing or it is making the product for the certain product and and it is not using and it is not establishing new products or services maybe. For
Okay.
example, and for example, Nvidia is looking for is working on GPUs as of now. It
Yeah.
is not working more on AI and other tools. It is working specifically on GPUs.
Yeah.
Revenue can be generated.
Yeah.
Yeah. Well, so yeah, revenue can be generated, and moreover, like, so product market fit is a stage of the company where you figured out that what is the right product to be built, who are the right people it should be sold to. The positioning of your company or your product is you crack the positioning, you figured out who you're going to compete with versus not, you figured out your distribution and how you're going to reach the customer, and you figured out your pricing. So basically everything. So in short, how do you tell if you've achieved product market fit? If a dollar of investment that you make into your business generates an outsized return, right? So you know that, hey, now I know how to build the product, I know who to sell it to for how much, and how to get it into the hands of the customer, right? So the minute you do that, now you're no longer a startup because now you're like any other big company. Now you're like, okay, I've figured everything out. All I need is कि अभी मेरे पास 10 लोग हैं जो product बनाते हैं, 10 market करते हैं, 10 sale करते हैं. Now I just need 1,000 of each, right? I just press on the accelerator. I have the right model. Now let me just get armies of people and let's grow the business. So you at that point usually you stop being a startup. You could still be privately held for a variety of reasons, but you're no longer a startup. And by large, usually what will happen is by the time companies reach this stage, they're filing for an IPO. Okay. Now, occasionally, what will happen is that somebody you may have so when somebody acquires your startup, they're acquiring it for for one of two or three reasons, or maybe a combination of those reasons. One is they're acquiring it for business reasons. So what do I mean by business reasons? It could be Meta acquiring WhatsApp uh, for $22 billion, not for the revenue, not for the tech. Yeah, right. The the tech that WhatsApp had wasn't tough. Anybody could have sat down and built it with a team of like 5 people, right? But what they're cracked is market penetration, right? Wild usage and the eyeballs. So they acquired it literally for the customers, right? Now there are other startups that get acquired for the revenue streams. So let's say you're a startup and you come up with an innovative CRM and you manage to get into a new market and you're generating a healthy 100 million a year ARR revenue. Then Salesforce might come along and say, you know what, we are just going to buy you guys out. We are not buying you out because you've got cutting edge technology in CRM, but you've already cracked a market that seems to be a niche, and let's just acquire you for your revenue stream. So what they might do is then they'll apply math, like I think somebody asked a question, how do you determine the number? So like in this scenario, typically they'll apply what they call a revenue multiple. Occasionally they'll do a profit multiple, right? So they'll say, look, for a company in this segment, which is technology CRM, it's a 7x revenue multiple. So if you're generating $100 million in annual revenue, we're gonna buy you out for between 5 to 7x, which is 500 to 700 million. Right? Now other times companies might acquire you not for your revenue, but because they don't intend to enter that market, but they think the technology and the team you built is really, really interesting. So they want the technology and they want the team that built it. So again, how much you get bought out for, it just varies on a variety of different